Hello, you're watching Dukascopy TV. I'm Ben Jones, bringing you the final targets in focus of the week. Markets are currently processing the implications of delayed tapering and gearing up for rate decisions from the Bank of England and the European Central Bank. Joining me on the line is Niels Christensen from Nordea Markets. Niels, the pound is heading for its biggest weekly gain against the euro since September, as it strengthened for the third day running versus the single currency. Now, this comes after a report has shown that manufacturing output in the UK has expanded once again in October to make it the 7th month in a row. With this manufacturing trend in mind, can you give us your 1, 3 and 12-month forecasts for this pair?
We still think that the pound will have the upper hand against the euro when we move into 2014. So for the cross euro sterling, we see it heading towards 82 in 12 months' time. It's not a very big strengthening of sterling during the next year, but what we have seen the last 2-3 months is that a lot of positive news from the UK has been priced into sterling. So we have actually seen a quite significant strengthening of sterling during the autumn, and we think that data going forward need to be very, very positive to increase the strengthening of sterling against the euro. So that's going to be difficult, but still we see headwinds for the euro going into next year, and thereby sterling looks to be the best bet between those two currencies.
For the 5th day running, the euro has weakened against the US dollar amidst fear that the ECB will cut interest rates as early as next week. This speculation comes after a slowdown in inflation and high unemployment data has been released. So with the euro heading for its biggest weekly decline since February, how do you see this pair performing over the short, mid and long-term periods?
It's correct that the euro has taken a hit this week due to the expectation about the easier monetary stance from the ECB. Looking ahead into 2014, in the short term, the visibility is very low, both for the euro and the dollar. Into 2014, we expect the dollar to be the strong currencies and euro dollar to be biased to the downside. We see euro dollar towards 125 in 12 months' time. But I would say towards year end, it's very difficult. Yes, we have the ECB and expectations that we could have more liquidity from the ECB and new LTRO, or we could even have a rate cut from the ECB after the very soft numbers, especially the low inflation data. So that would keep the euro quite soft and weak. But at the same time, we're also moving into the end of the year where we could have another budget crisis in the US. What we have seen more or less all year is that rate expectations, interest rate differential have been the main driver for euro dollar. Over the autumn, everybody was busy scaling back their expectation about tapering in the US, and that hurt the dollar, and we saw euro dollar moving all the way up to 138, and now focus has changed, and focus is back on the ECB and actually risk of lower rates in the euro. So we have seen a sharp correction in euro dollar this week. So it's pretty open, I would say, for the next 2-3 months where euro dollar should be heading. If we get another budget crisis, if we get soft numbers from the US, if we don't get a rate cut from the ECB, year end we could be closer to 140 than towards 130. Our call is in 3 months' time 133, but it is with a lot of uncertainties. But as I said, going into 2014, we think that tapering will be on the table, and then if not in the first quarter, then in the second quarter, and that's going to change the longer term view for euro dollar to the downside.
The Fed decision to delay the bond tapering and continue to buy $85 billion worth of assets per month has seen the greenback gain on the yen this past week. What will be the next key event for this pair? Perhaps next week's Bank of Japan meeting minutes? And what are your forecasts for this pair over the 1, 3 and 12-month periods?
Yeah, for dollar yen, we think that it will be the dollar that will be the key driver and actually making dollar yen moves above 100 and also breaking above this year's high at 104, 105 you say by the middle of next year, and then 110 at the end of next year. That's our call for dollar yen. It's very much a dollar story, and again back to tapering. With tapering as we see it on the agenda, if not in the first, then in the second quarter of next year, that will actually force U.S. rates higher, and the interest rate differential will move in favor of the U.S. dollar against the yen. And we think that the yen and the euro will be the weakest links amongst the majors next year. For the yen, if we look at Japan, well, it doesn't look too bad in Japan, but definitely Bank of Japan will be very, very cautious and will not act soon. They would rather wait and be 100% sure that the economy is gaining momentum and that inflation is moving out of the negative territory, and so they can put deflation behind them. A question mark in Japan is obviously how big effect this sales tax the government has decided on, and that will be introduced slowly next year. How big an impact that will have on private consumption, and obviously it will have a negative impact, and that will force the Bank of Japan to stay put while we see the Fed moving ahead with tapering. So they will reduce the quantitative easing, and after that they will begin to actually tighten the liquidity in the U.S. before hiking interest rates, hiking the Fed funds when we move into 2015. But all these rate hike expectations in the U.S. will force the interest rate differential in favor of the dollar, and that's the main reason why we think dollar yen will be one of the big mover next year and moving much higher than the current levels.
Thank you for joining me, Niels. Now that is all for today's Targets in Focus. Join us next week as we get more market insiders to share their forecasts. But for now, goodbye.